I want you guys to take a look on the right side of the screen on the depth of market visualization and try and notice what is abnormal about the market currently. So what you guys just saw right there was an example of spoofing and how L2Azimuth picked up on it and took a trade to exploit that trader's behavior. So before we talk about exactly what happened in that trade leading up to us getting filled into a short position, I first need to explain what spoofing is. So spoofing is a method of market manipulation where bad players who are trying to manipulate the market can create a false sense of supply or demand by creating limit orders that they actually never intend to get filled. Now, this isn't really that hard to detect from a heuristic standpoint once you've modeled it, but it is very hard to prosecute. Last year alone, the CFTC collected $4.3 billion in fines that targeted spoofers who were trading futures and manipulating the market. Now, it's been illegal since 2010, so the fact the CFTC has made over 96 enforcement actions in the last year alone, that says something about how effective our prosecutors are at actually stopping this behavior. And spoofing is incredibly harmful. It's the only reason why you stopped hearing people talk about the depth of market in relation to successful trading strategies. The depth of market used to be the way to trade. You were actually able to get a clear view on where current buyers and sellers were in relation to current price. But what happens if you can not only avoid areas where spoofing is occurring, but even exploit the now transparent nature of the activity itself? To talk about that, we'll first have to dive into what typical spoofing behavior looks like. The figure displayed on the screen is taken from an actual spoofing case. The anatomy of typical spoofing behavior is that a bad actor will place fake orders with the intention of moving price in a direction that is advantageous to them. Once they've completed their entry, they will then cancel these orders, which will then cause the market to correct to the original level, leaving them with a profitable outcome. They will often rinse and repeat these cycles, swapping back and forth between long and short. What we've achieved with L2Azimuth is a completely heuristic-based method to automatically detect these practices, as well as avoid falling victim to them. This allows for a completely new way of trading, where level 2 data is actually reliable. You're once again getting a true picture of supply and demand from level 2 data, just like it used to be. So now that you guys are familiar with what spoofing is, let's go back and let's review what happened during that first trade. You might be noticing a wall of demand that is seemingly chasing price, never getting filled, but continuously following the bid. Besides what you just saw, we have 132 buyers one tick away from the best bid. Immediately in the next frame, we saw price move up 3 ticks with potential spoofed orders following the best bid. Now looking directly 100 milliseconds after that last visual, we saw 12 orders filled, with price only moving a single tick. However, we saw 112 buy orders displace themselves, meaning these had to be moved away manually. Only a quarter of a second later, we saw 45 orders executed, but with 125 buy orders removed, leaving us with 80 buy orders that are unaccounted for. L2Azimuth is now extremely certain that there is spoofing behavior occurring at this level, and it's currently looking for the best opportunity during the observed spoofing cycle to take a trade. Immediately after this, L2Azimuth bets on the spoofer canceling the fake orders that are directly below the current price by taking a short position. This is a calculated risk that's being taken, and you can see as we're at the bottom of the cycle, these orders are canceled, with price falling through practically instantly. So you've seen it in action, but how did we actually do this? Using insights from 58 pages of groundbreaking research from Dr. Bo Lin Do and Professor Talise J. Putinich, we've built a model that not only detects spoofing in real time, but turns it into a profitable opportunity. Again, we didn't invent this method. We simply applied these findings and enhanced them with our own augmentation. We've created the first retail available detection system that not only works when public, but increases in effectiveness with the more who use it through the critical mass effect. Let's quickly go through our core metrics of our methodology. Number 1, high quoting activity. This metric tracks the difference between the volume of new orders on the bid and ask sides, specifically within the top 5 levels of the order book, The greater the imbalance, the higher the probability of manipulation. Unbalanced quoting. This identifies cases where there is a significant imbalance in the quoted sizes between the bid and ask levels, indicating that the manipulator is placing deceptive orders. Abnormal cancellations. Spoofers often cancel large portions of their orders after moving the market. This metric tracks unusually high levels of cancellations at key moments. Trades that oppose quotes. This detects when trades are executed in a direction opposite to the quotes being placed. A clear sign that the quotes were fake and designed to manipulate. This metric, along with the next metric, are not necessarily as applicable for retail traders. Cancels that oppose trades. Similar to trades oppose quotes, but focusing on order cancellations that are inconsistent with the direction of trades, indicating manipulation. Cyclical patterns in depth and cancellations. These metrics capture repetitive patterns in the depth of the order book or in cancellations, which are common in layering and spoofing schemes. Finally, all of these metrics are passed through boosted tree and random forest machine learning classifiers, which are then combined into a probability index. This index estimates the likelihood of manipulation occurring at any given time, as well as which direction the manipulation is currently happening in. I'm not going to bore you guys and go through exactly how we do this final process, but I've posted the link to our paper, which we talk all about how we do this, in the description. But to get back on topic, the unoptimized logistic regression model achieves an AUC, or area under the curve, score of 0.77. However, by applying the techniques we mentioned earlier, that detection accuracy is increased even further, with AUC scores of 0.81 and 0.82 respectively. These nonlinear models allow accounting for any complex interactions between these metrics that may not be possible to quantify with a traditional numerical method. Again, huge thanks to Dr. Bo Lindo and Professor Talise J. Putnich for this extremely valuable research. So, we've detected spoofing, and now what? How do we profit from it? Let's clarify something up front. We're not profiting from the spoofer's unethical behavior. Instead, we're taking away their ability to profit from it. When spoofers manipulate the market by creating false liquidity at synthetic price levels, they're tricking other traders into reacting. But with our detection model, we turn the tables. By actively stepping in and countering their strategy, eating away at the liquidity they falsely created, we're neutralizing their advantage. In fact, we're not just stopping them from profiting, we're making sure their manipulation works against them. Our approach directly counters their game plan. By understanding how traders respond to these spoofed orders, we trigger trades that capitalize on the price movement caused by this deception. Hey guys, so this is the 3D plot of our portfolio Sharpe ratio when running spoofing detection on varying filtration levels. So essentially what that means is that this axis right here is when we're only using spoofing identification as a metric for entries, and this one is if we're only using micro forecasting for entries. So you can see with micro forecasting only, we barely get above a Sharpe ratio of 1, which is about equivalent to the S&P 500. That's not great, especially on futures with the amount of leverage that you have. You're probably going to blow up your account if you just followed the micro forecasting certainty score. Over here, we end up getting to a Sharpe ratio of about 1.91. Not stellar, but we do focus on high portfolio stability and low portfolio volatility at Futures Analytica. So what we found is that when you combine these two metrics, they're very uncorrelated. So what ends up happening is that they almost exponentially add to each other. So the scanner will generally take trades immediately above this level here. So you end up having a peak Sharpe ratio of 4.48. In order for me to contextualize that number, I'm going to be showing you guys a different graph. So these numbers are normalized, but they do show the difference in portfolio volatility between a portfolio that has a Sharpe ratio of 1.9 versus one that has a portfolio Sharpe ratio of 4.48. You can see that the equity curve is just so much flatter. It's much more consistent, and you have an expectancy rather than a, this probably will end up working out in the long run. So this is really the kind of returns that we're looking for at Futures Analytica. The raw returns themselves are not really that impressive, and I don't ever look at that metric when looking at futures trading strategies, specifically because of the way that the margin system works in futures trading. Looking at raw account values or even account percents just doesn't make sense as a metric for evaluating whether or not a strategy is successful or not. But here's what gets even more interesting. As more traders adopt this counter-spoofing strategy, we reach a tipping point, a critical mass phenomenon. Spoofers rely on their synthetic orders not getting filled. Their strategy only works if they can cancel those fake orders in time. However, as more traders start to challenge this synthetic liquidity, something surprising happens. The spoofers' fake orders start getting filled before they have the chance to cancel them. And now they're trapped in checkmate. When this happens, spoofers are forced to exit their positions using market orders to avoid further losses. This frantic exit pushes the price in our favor, creating a positive expectancy trade. This phenomenon not only removes the probability of spoofing, but flips the script entirely, trapping the spoofers in their own game and driving profits to those who counter them. Now, it is impossible for us to actually have a number in terms of how many people we would need to reach this critical mass phenomenon before we sell it, but we will keep you guys posted as after this release, we will have more data on how things are going with that. What's great about being able to detect spoofing is that it allows us to avoid areas where there are spoofing for our other strategies. Our other scanners become so much more powerful with counter spoofing acting as a filter. Now, to circle back to what I mentioned earlier, where I talked about how the limit order book had become unvaluable, how it was no longer an easy way to trade like it used to be. There used to be a time when traders relied on the limit order book to give them a clear view of supply and demand. It was the go-to method for making reliable, profitable trades. But spoofing distorted this view. Traders could no longer trust the order book, and depth of market-based strategies lost their edge. And that's where our software comes in. One of the most important scanners we use is called the trespass scanner. Built on a liquidity imbalance strategy, not to be confused with order flow imbalances, this scanner operates on a distinctly different metric, focusing on liquidity imbalances in combination with a proven method for price prediction. And that proven method lies in the algorithm presented in Q imbalance as a one tick ahead price predictor in a limit order book by Martin D. Gold and Julius Bonart. This method, used for predicting price movement based on order book data, was once simple and highly effective. However, when the researchers performed the same study 5 years later, they were puzzled to find that their original methodology was no longer accurate in current markets. And the reasoning behind this is just the proliferation of spoofers distorting the picture, flooding the market with fake orders and rendering the traditional order book signals unreliable. And that's where our trespass scanner changes the game. By combining the proven one-tick forecasting method with two critical filters, one for detecting spoofing and another for microprobability, we restore the accuracy and profitability of these strategies. Our software filters out the market manipulation created by spoofers, allowing the model to once again deliver high confidence, actionable predictions based on genuine market data. The trespass scanner alone accounts for almost 65% of our trades, because liquidity imbalances occur very frequently, providing reliable on-time signals. By incorporating the spoofing filter, we ensure the data used for price prediction is clean and trustworthy, further increasing our scanner's accuracy. But there's another layer to this. The second key filter we use is our microprobability two-tick forecasting system that you can see at the top right. This generates a probability of where the market is going to go in the next 2 ticks on the fly. Through our experience building Polarity, we've learned a lot about how to effectively use machine learning in practice. We discovered what works, what doesn't, and how to minimize the pain points of training phases. That led us to settle on an in-memory, on-the-fly Bayesian machine learning model for this strategy, one that does not require any manual user training. Everything is completely automatic and always up to date. No need for incremental learning when your data is as recent as it is. The two-tick forecasting model is specifically designed to filter out periods where market microstructure is not the dominant force driving price action. It classifies outcomes using limit order book tick data to predict price movement with high accuracy. However, we've learned from industry experience that feeding tick data into machine learning models without addressing the garbage in, garbage out problem often leads to underwhelming results. By removing the garbage, namely price action driven by spoofing, we've made the limit order book data incredibly valuable for not only trading, but for training our machine learning model, producing genuinely predictive outcomes. Now you're starting to understand why removing spoof data can change the perspective that you guys have on the market significantly. On its own, a two-tick forecast, even if highly accurate, wouldn't provide enough of an edge, especially when you factor in slippage and commissions. And in cases where limit orders aren't filled immediately, the market can shift before they're filled, which diminishes the usefulness of the two-tick forecasting system. But we don't use this model as a standalone system. Instead, it acts as a filter. When we combine it with our scanners, including the trespass filter, we only execute trades where both the scanner and the two-tick forecasting model are in alignment. This combination is where the real power lies. If you want to read more about how this model is driven, check out my white paper in the description, where we go through almost all of the math that drives our models to make highly informed decisions. Let's talk about the DEX array scanner, which is arguably the most consistently reliable scanner in the entirety of L2Azimuth. So the way DEX array works is that it'll identify aggressive limit orders that are placed between the bid and ask prices. This is called a spread collapse. You guys might have noticed that while ES usually has a one-tick spread, which is the lowest spread you can have, sometimes it'll have two. Now, I wonder if you guys have ever observed how price reacts after that spread closes. It's actually pretty interesting, and it's the entire basis of what we've designed L2Azimuth to do with the DEX array scanner. So with this spread collapse metric, we combine this with the microprobability score and the spoofing metric. One of the biggest prerequisites of a DEX array trade is the fact that the spoofing score has to be so low. Now, the reason why this is important is that because we're looking specifically at one limit order level, the one that actually followed up with someone who spread collapsed, that factor really highlights the importance of having clean market data where your data isn't being spoofed. What really sets DEX array apart is its ability to work seamlessly with runners. The scanner excels at capturing moments where you can ride a trade for extended price movement. It's not about quantity with DEX array, it's about quality. So even though we only got one trade in this whole video, the trade it gave us was backed by layers of confirmation and reliability. I'd say for the beginner who is trying to start trading L2Azimuth just from the start, I would stay away from the trespass scanner and really master the DEX array scanner first. It's very, very simple. And after that, introduce some counter spoofing, and then you can finally introduce the trespass as you gain a lot of knowledge on how counter spoofing works. And now there is something else I want to address. Transparency. As a trader, it's something that has been exceptionally important to me. Over the past 2 weeks, I've taken L2Azimuth live on YouTube multiple times, trading with real money, in real time, with zero delay. I've also taken live questions from viewers during the process. This isn't just a one-time show. I'm committed to continually doing that moving forward. And this isn't something new. For over a year and a half, I've been doing the same thing with all my previous trading strategies, whether it's L2Azimuth or another system. In this industry, you can fake almost everything. Brokerage statements, P&L visuals, and you can easily cherry pick your best trading days to show off. But one thing you cannot fake is a no delay live stream. If you're watching the trades execute in real time with the entries matching the live price, there's no hiding behind post-production or selective reporting. What you see is exactly what's happening. A live, no delay stream removes all the smoke and mirrors. You're seeing trades executed as they happen at the same price and in the same market conditions as I'm trading in. That's the kind of transparency that can't be faked, and that's why I've made it such a huge deal on how we conduct business at Futures Analytica. Transparency isn't just a value, it's a practice. It's part of why I'm so confident in what L2Azimuth can do, because it's already been out there, working, live, and on display for everyone to see. And that really does lead me into a commonly asked question. Why in the world would I, someone who has developed what seems like a point-and-shoot trading system, sell this at all, let alone to the public? So first off, there is something that I call the critical mass principle. Remember how I mentioned that spoofers will balance their payoff to risk ratio by spoofing at prices that they think have a low chance of being filled? Well, imagine what happens when enough buy orders flood the market in response to a sell spoofer. The spoofer is suddenly stuck in a massive risk-heavy position with no edge. From the court documents I mentioned earlier, we got a glimpse into the logic behind their strategies, made public through subpoena. When spoofers are inadvertently filled into too many orders, their system hits panic mode. They dump their positions to market with no exit strategy, causing a ripple effect of buying pressure as they scramble to close out their trades. In the scenario of a sell spoofer, this results in a massive surge of buying activity, which only increases the capital returns of the strategy. It's a phenomenon that I simply can't achieve on my own. Just the level of money required to actually move the market up just even a few ticks is kind of ridiculous. Well, I don't know if it's realistic to reach this critical mass with just my number of customers. I do think it is a wager worth making, given the ridiculous payoff for everyone who'd be involved in a transaction like that, myself included. And honestly, just how funny it would be to watch the spoofers get trapped by their own tactics. Secondly, maybe a more selfish reason, ending spoofing creates major opportunities for Futures Analytica. As a research firm, a huge portion of our revenue is directed towards research, validation, and development of trading systems. We've poured massive amounts of resources into systems that just didn't turn a profit, especially depth of market strategies. Even non-depth of market strategies we've developed were unprofitable due to price distortions caused by manipulation, largely driven by spoofing. If we can put an end to spoofing, the market becomes more fair, and we can deploy strategies that we've already spent considerable time and money developing. Strategies that, under cleaner conditions, would be highly profitable to my portfolio. Third, and probably the most straightforward, I make money off of the sales to this product, and I will use those profits to research more edges for myself and my company. Some I'll end up selling to the public, and some I won't. And yes, I'll probably take a pay package from this. Now, what we've done with this edge is something I believe no other firm has achieved. We haven't just democratized access to a high fidelity edge for retail traders. We found a market-driven incentive that actually enhances the strategy's effectiveness as more traders use it. Typically, the more a strategy is adopted, the less effective it becomes. But our edge is strengthened by the critical mass effect I mentioned earlier, along with the structural changes that make DOM-style trading viable again. By giving more people access to this edge, we're taking meaningful steps towards ending spoofing entirely as a practice, not through regulation, but by making it so unprofitable for spoofers that they have no choice but to abandon it altogether. This isn't just about providing a profitable tool, it's about changing the landscape of the market itself.